Hello investors. The current price-to-book ratio for Intel as of November 2022 is 1.2. This is the lowest in the last 10 years. As of today, Intel's share price is $29. Intel's book value per share for the quarter that ended in September 2022 was $24. Hence, Intel's PB ratio today is 1.2. But does that mean that Intel is a good investment? Some assets on the books can be a mirage. The real value depends on the quality and liquidity of the assets on the books. The assets may be carried on the balance sheets at the original cost minus depreciation. This may underestimate or overestimate the true economic value because the assets can become obsolete. This can be easily the case with high-tech companies like chipmakers. Today we will learn about a stock valuation metric that compares the share price to the book value per share. The price-to-book ratio, if used properly, can help you to make a more informed decision about which company may be better value for your money. This ratio compares a company's stock price to its book value, or value of everything the company owes, free and clear of debt. Here's the formula. Price to book equals stock price divided by book value per share. Value investors use price to book ratio as a quick test to find obvious value stocks. A price to book ratio of 1 looks very good. Of course, unless the assets are a bunch of rusty and used machinery. A price to book ratio of less than 1 can be a buying opportunity if book assets are quality assets. If assets are factories, inventories, goodwill, they can be hard to value items or can become obsolete. In the software industry, for example, if research and development is properly expensed and intellectual capital intangibles are aggressively amortized, book value and price to book ratio will be low. Software companies have very light assets and price to book ratio does not work well for these companies. If assets are cash, securities, land, marketable natural resources, there may be an investment opportunity. In financial services industries, where most assets are actual dollars, the price-to-book ratio can have a greater meaning. The price-to-book ratio works the best for the businesses that earn most of their profit from their assets, like banks, financial investment companies, real estate companies, energy companies, transportation businesses. These are companies that tend to be capital-intensive and have a really large amounts of assets. In this video, I'm going to show how to find the price-to-book ratio of Blackrock, ticker BLK. You can find all the information for free on Yahoo Finance. They will also calculate for you the price-to-book ratio in the Statistics tab. Just scroll down and you will see price-to-book ratio, that now is 2.9. But you would like to calculate it by yourself, right? In this case, you will go to the Financials tab and select the balance sheet. Here we are looking for the stockholders' equity, which in this case is about $37.7 billion. Then we're going to divide this number by the total number of shares. If you scroll down, you will see that the number of ordinary shares is 152 million. This gives us the book value per share of $248. If you divide the current share price of $729 by the book value per share of $248, you have the price-to-book ratio of 2.9. Another way we can look at it is to compare it with the price-to-book ratio of other kinds of asset management companies that are within the same sector. BlackRock is in the asset management industry. You can find the average price-to-book ratio by sector on the NYU Stern School of Business website. You can find the link in the description below. If you look for investment in asset management, you will see that the average price-to-book ratio for this particular sector is 2.78, so BlackRock actually is quite fairly valued in its sector compared to the other companies that are also in the investments and asset management business. But as Benjamin Graham said, a stock does not become a sound investment merely because it can be bought at close to its asset value. The investor should demand, in addition, a satisfactory ratio of earnings to price, a sufficiently strong financial position, and the prospect that its earnings will at least be maintained over the years. If there is a large cash position, make sure the company is cash flow positive. You don't want this cash to disappear. In the 1983 letter to shareholders, Warren Buffett pointed out the difference between book value and intrinsic value. Book value is an accounting concept, recording accumulated financial input from both contributed capital and retained earnings. Intrinsic business value is an economic concept, estimating future cash output discounted to present value. Book value tells you what has been put in. Intrinsic business value estimates what can be taken out. An analogy will suggest a difference. Assume you spend identical amounts putting each of 2 children through college. The book value measured by financial input of each child's education would be the same. But the present value of the future payoff, the intrinsic business value, might vary enormously from 0 to many times the cost of the education. So, also,
Do businesses having equal financial input end up with wide variations in value? In the 1988 letter to shareholders again explained how circumstances may change and make some assets obsolete. Berkshire's past rates of gain in both book value and business value were achieved under circumstances far different from those that now exist.
Anyone ignoring these differences makes the same mistake that a baseball manager would read to judge the future prospects of a 42-year-old center fielder on the basis of his lifetime batting average.
Take the breakfast cereal industry, whose return on invested capital is more than double that of the auto insurance industry, which is why companies like Kelp and General Mills sell at 5 times book value and most large insurers sell close to book. The cereal companies regularly impose price increases, few of them related to a significant jump in their costs. Yet not a peep is heard from consumers. But when also insurers raise prices by amounts that do not even match cost increases, customers are outraged. If you want to be loved, it's clearly better to sell high-priced cornflakes than low-priced auto insurance. Thanks for watching. Do you usually use ratio when evaluating a stock? Let me know your process in the comments. If you enjoyed the video, give it a thumbs up, subscribe for more, and I'll see you in the next video.